Hi everyone, Jeff Yasteen here. Make sure to subscribe to our YouTube channel. Follow me on Facebook and on Twitter. And also remember to like and share the video, please, if you find it valuable to your investing knowledge. Now, what about this stock market? I mean, if you're new to investing, times like now where the market is selling off, it can make your head spin. I mean, it was only 3-4 weeks ago that everyone was incredibly optimistic. A vaccine is right around the corner. The economy's doing okay. Of course, that's with a lot of help from the Fed and government stimulus checks. So then there's now, which it's like everyone did an about face. Maybe a vaccine isn't right around the corner. Maybe COVID-19 is rearing its ugly head right now and we're going to get that dreaded second wave of the virus. Maybe things look too chaotic for the upcoming election. Maybe the stock market, which seemed like so much fun before, isn't so much fun now. Well, you know what? Welcome to the world of investing. Let me tell you a little story, a personal story. Back in 1998, I was still learning how to trade, and I was becoming steadfastly bearish in my outlook heading into the fall. And sure enough, the market did just that, falling all the way into October. And I added more bearish option bets. And I was convinced that the market was going to fall still further given the volatility of the time. And I can still remember checking by phone where the market was late one trading session. I was out doing my real job. And instead, the market was up quite a bit when I expected it to be down. And the next day, it moved straight up. And it kept going straight up more or less for the next 18 months until the real top of the market in March of 2000. Now, I don't know if that's going to be the case this time, but I hope that little story demonstrates how wrong we all get it. And it happens quite often. So when you are wrong, you need to cut your losses quickly. And when you're right, you need to ride that horse as far into the sunset as you can. Small losses, big winners. Just keep repeating that to yourself. So if you've been following my videos for a while, you know I've been warning about the sell-off we've seen over the past few weeks for a while, beginning with this video, which I posted in early August, that the big market rally would likely come to an end by Labor Day weekend. And that's what happened. This is what it's like. We swing from extreme optimism to pessimism and back again. And the hard part is keeping your own head straight and not allowing yourself to get caught up in the emotion of the moment, at least not too much. So it can all get very confusing. And the hardest part is that no one can offer you real certainty. And that's because the stock market is about probabilities, the odds of something happening or not happening. It's like a horse race that goes on every day where the betting never stops. And from that standpoint, I think the odds are telling us that we're nearing a bottom. Now, I would not have thought that a month ago, but my sense of things is that investors have gotten very bearish very quickly. And that's typically a sign of at least a near-term bottom for a handful of weeks. Now, I'd be more inclined to stay bearish and bet on lower prices if investors were doing just the opposite, becoming more bullish as prices fall. And that's the sign of a real top, when investors increase their bets as their favorite stocks fall in price. And we saw lots of evidence of that happening in 2000 and in 2007 as those bear markets set in. And so far, that has not been the case with this market. So the time, in my opinion, the time to start laying your bets on higher stock prices in certain groups of stocks is now. For instance, I bought 500 shares of the QQQs, the NASDAQ 100 ETFs, here on Thursday morning. Now, don't follow me into this trade. Don't bet at my size. If I'm wrong and the market falls deeper, obviously I'll cover my bets for a loss. But I'm judging that enough people have moved to the bearish side of the scale here that the stock market is going to move in the opposite direction. So let's suppose I'm right. How long could it keep going higher? I don't know. That's the whole point. If the overall market moves higher and people stay stubbornly bearish and pessimistic, then I have at least a small clue that maybe, just maybe, the market will keep moving higher in fits and stops until more people are converted over to being bullish again. And if I'm wrong, we'll know that soon enough. So that's something as investors and as traders we have to keep in mind at all times. Right when we think things couldn't be better, when things look terrific, that's when Wall Street traders lower the hammer on us. And it works the same way in the opposite direction too. You get too bearish when the news just seems so obviously bad and it appears it's going to stay that way. And it's sort of like your high school physics class where they say that for every action there's an equal and opposite reaction. Now, how do I arrive at that conclusion in terms of investors getting too bearish? Mainly, it's about sentiment. What the majority of investors think and feel about the market at a particular moment in time. As a visual example of how quickly things have changed, check out this. This is CNN's Fear and Greed Index. Now, there's nothing magical about it. It's just a compilation of various ways that investors and traders express their views about the market. For instance, the buying interest in junk bonds, which are the riskiest part of the bond market, or the volume in put options, which are bets that stocks are headed lower, versus the volume in call options, the number of stocks hitting 52-week highs, and so on and so on. Now, it was only a few weeks ago that most of these indicators were at levels of greed or extreme greed. Now, some have moved to neutral, and a few have moved to levels of fear and extreme fear. There are other ways to measure sentiment as well. For instance, one financial columnist whom I've read for years documents in minute detail the short-term bearishness and bullishness of newsletter editors. We're human, susceptible to the same tides of opinion as everyone else. And as he's documented over many years, when newsletter editors that he tracks, and I'm not one of them, get really bearish, it's most likely time to move in the opposite direction. So it's just human nature. And does following sentiment really closely work every time? Of course not. You can't call bottoms all the time on this sort of thing. Like I said, the stock market is about probabilities, not certainties. If we want certainty, we buy bank CDs and we're happy with a guaranteed 0.25% on our money, or whatever it is these days. And there's nothing wrong with owning CDs. I own some myself. But for better or worse, we're compelled to seek stronger returns in the stock market. And for that potential reward, it also means accepting a degree of risk, the chance that we could lose money. And that's why I think it's worth paying attention to sentiment levels, because they have the potential to lower your risk. And by that I mean when sentiment levels are super high, like they were in late summer. If we're buying the most popular stocks, then we're buying at very high prices. And when sentiment levels are neutral to bearish, like they are now, then you're buying at lower prices. And that's the whole point, to buy low and sell high, right? Now, we can take sentiment levels one step further and look at them as an extension of how investors value a particular stock. Now, it's too much for me to go into in this video in detail, but basic measures of value, price to earnings ratios, book value per share, and similar metrics, they're all based in part on how investors feel about a particular stock. Because if they're not enthusiastic about it, or in some cases they hate it entirely, they will express that opinion by selling the stock and the price goes down. And that gets reflected in the ratios. Now, if you can look a little deeper, sometimes you can see a disconnect between what the market thinks, what investors think, and what the company's results are now, or what they're expected to be in coming quarters. And if you do that, you just might find a winning stock that most investors are not going to realize is right in front of them until the company's stock price is far higher. So it's something to keep in mind in terms of how I look at stocks, and perhaps how you want to look at stocks too. If you like what I'm talking about, again, make sure to subscribe to us on our YouTube channel. Follow me on Twitter and on Facebook. I'm Jeff Yasteen.